Welcome to the Halftime Report. I'm Scott Walker, front and center this hour. The state of play for stocks, the election, big tech earnings getting ever closer. Joining me for the hour, Josh Brown, Liz Young-Thomas, Jenny Harrington. We will go to the markets. Take a look. We are red for the Dow. We're barely positive on the S&P. NASDAQ's where the show is today. It's up about 0.5%. Thank you very much, Tesla, helping there. Claims were below. PMIs were better. Yields are steady. HSBC raises their target to 5,900. We're at 58. So a little bit of upside left between now and the end of the year. Highest remains 6,100 from our guy, Brian Belsky. Josh Brown, your view on, the state of stocks right now is what?
In an upward trend, still in a bull market, perhaps consolidating, which I would argue is healthy. You want to buy the consolidation periods. You don't want to throw confetti at record highs and then press the buy button. I don't know if you know this, but that's not how investing works. So if we should get more of a pullback because people are freaked out over 10-year yields, I'm coming in and buying. And I think that's what you rationally would want to do if we think we're somewhere in the middle of the cycle, which, maybe not. The big swing factor for me, whether or not we actually are, is if we get a housing cycle. And one of the economic stats you didn't mention, Judge, and I will, new home sales were 738,000 in September. That's almost 20,000 more than expected, which is pretty good. Prices were up 3.7% sequentially. The mortgage rates pulling back is very constructive for the real economy. If we get some semblance of a housing cycle after 2 years of a frozen market, that has a very big economic multiplier effect.
You don't think what's happening in October with rates is a reversal of that? Rates have backed up again.
It's a fluid situation.
7% I just saw this morning on the 30-year fixed.
It's a fluid situation. I think the trend in rates is lower. I think the trend in Fed funds rates is definitely lower. Maybe at a slower pace than what we thought, but that's a good thing. The economic data continues to either be at par or surprise to the upside. Why would they be in a rush to cut rates, overnight rates? So I still think it's a downward trajectory for the overnight rate, and ultimately mortgage rates will follow through to the downside. We're not going to plunge. I don't know what the terminal rate will be in this cycle, but again, if you have demand for housing, the labor market holds up, the consumer continues to do what it does, and we keep hearing blowout reports from companies like Tesla and Netflix. You want to buy the pullbacks from highs, not cry about them.
So, Liz, markets have been trying to game out the election as best they can. They've been betting on a reflation trade. You've seen it in yields, you've seen it in cyclicals, metals, the dollar, etc.
Yep.
Whether or not that turns out to be right, we'll see. If nothing else, though, most are expecting a pickup in volatility between now and Election Day. Sentiment's likely to stay vulnerable near term, according to UBS. They're still positive, like Josh, but as November 5th inches closer, the market sentiment is likely to stay vulnerable. What do you think?
Well, we're getting pretty close now, and I think we've been waiting for this volatility, the normal seasonal volatility that you get in an election cycle. Typically, September is volatile any year. In an election year, even more so, and then it usually extends into mid-October. We haven't really seen that this year. So now we're in this period of, oh, wait, let's catch up and be volatile for the last couple weeks before the election. To Josh's point, I don't mean to throw cold water on your point, but yes, new home sales were healthy. However, existing home sales earlier this week were not. We hit a 14-year low. So there's actually still a pause and a freeze in the mortgage market because rates have gone back up. I agree. I don't think we're going to plummet from here. And the only way that we're going to see a really big drop in the Fed funds rate is if something terrible happened and they had to try to save it and catch up on the other side. But things are healthy. The economy seems stable, everything. And I've said this before, if we could freeze everything in time right now, that would be great and keep it here. So far, that seems to sort of be the case. The relationship that needs to work the way that it should is different from what we've seen. We can't have yields up, stocks up in perpetuity. So at some point, stocks do have to take a pause. And I think we're seeing a bit of a pause now, which is normal after this rise in yields.
You could have yields and stocks could rise together if yields are going up because the economy is strong. You can't have an endless backup in yields, obviously. At some point, you would have a problem. But there's nothing to say that if the 10-year stood at 420, that the stock market can't handle that if earnings remain strong and the economy remains
The 10-year average 5% in the 1990s. We were fine.
It can handle it. It just can't continue going up at, double-digit percent. So what we've seen for the last few weeks or so is what's called a bear steepening environment in the yield curve. So you've got 2s and 10s both rising, 10s rising faster because the economy is strong. Usually the pattern you see then in sectors is cyclical sectors do well. Now tech has led, but semiconductors have led that, which is the cyclical part of tech. So the pattern is working as it should. I just think it's probably going to get exhausted at this level in yields, as it also should.
BTIG's Jonathan Krinsky today says continue to see downside risk. We continue to see a risk for equities broadly over the coming weeks. S&P pulled back to 55 to 56.50. That seems a decent probability. Jenny, there's some conversation that the election may be a sell the news, that we're pulling up some forward here. As I suggested, we're gaming things out. Some are. Whether they prove to be right or wrong, we'll wait until however long we have to wait to see what the result of the election is and what the fallback is in the markets.
I think, to me, of the outcomes, that's the most probable, because it is just kind of frothy. And when you look at the market where it is at 5,800 and change, to me, that's incorporated in 6 rate cuts over the next year and change, which is 150 basis points. It's incorporated in, it's fully incorporated in next year's $275 of earnings, which is a 22 times multiple. Awfully loud back there.
I agree with you.
Yeah. I was really smart. But it's incorporated in all the good news right now, and I think it's hard to sustain. I am nervous about earnings next week. I'm sorry, Liz, to your point about the 10-year being 420 and it being a bear curve steepening, that makes sense to me. Like, why is it 420? I don't think it's for good reasons. And to Josh's point, that both yields can go up and stocks can go up, that's if yields are going up for the right reasons.
Yeah, Ingram Micro, by the way, re-IPOing, and that's, of course, the bell that you hear behind Jenny that she was referencing, and all of you probably heard a few different times. There's the IPO as it just opens for trade.
Wait, what do you think is the reason?
I'll tell you exactly what I think it is. I think it's that we all know rates are coming down now, right? And they are. You see inflation coming down, and generally the 10-year follows inflation in the Fed funds rate by about 1%. So that will point to, in the near term, the 10-year being 3.5-ish, right? But I think the problem is that for the first time in a really long time, the conversation about our fiscal deficit, about our national debt, is starting to happen. Like, I have not heard people talk seriously about that in what feels like 10 years. And everywhere I'm turning, whether it's the client side or the professional side, it's starting to be acknowledged. And what we see is that we're going to have these massive national debt, deficits. And with those come higher inflation and come higher interest rates. And so I think there's this kind of honeymoon period where rates come down, and then it starts to go up. And so I look at that 420 as the bond vigilantes starting to do their work and starting to have a bear steepening, where you look out and you're like, hey, you know what? We're not in great shape. We need to get serious. We're going to have insane amounts of debt service. Right now, it's about $1.2 trillion just to service our debt. That eclipses the defense budget. Like, these are not good things, and they dampen and restrict future growth, right? I'm not saying it makes future growth go negative. I'm not saying I think there's a big bear market coming. I just think that there is less growth potential ahead if we continue on this crazy spending stream, and neither of these candidates do anything.
You really think that that's what's driving the 10-year yield, or you think, or is it possible that it's just the people that watch that and worry about that are looking at that back up in the yield and now coming on TV to talk about it because it might be their theory finally coming true?
I'm not sure, Josh.
There's another theory that there was a huge recession bet. We had record flows into bond funds this year. Bond ETFs, forget about it. They shot the lights out. And some of that gets unwound if you don't have a recession, and some of the election fear is coming out of the market. And maybe that's why yields are backing up, because people are coming out of bond funds. There's other theories besides the bond vigilantes that I've been hearing about for 25 years.
Correct. But I think however you cut it, when the 10-year is at 420, that becomes more competitive to stocks. And what that does is dampen the multiple that people are willing to pay for stocks broadly, which restricts future growth.
Can we talk about certainly one of our stocks of the day? It is Tesla. We mentioned the NASDAQ is the outperformer today. Discretionary is the leadership group out of the S&P because of Tesla. That's after the results. The best day since March of 2021. It's certainly one of the best stocks out of the S&P today. up 19%. I thought interesting in relation to this stock and those earnings and the types of things that Elon Musk talked about last evening. If you pull up Uber, you can see perhaps some of the impact of all that impacting Uber, which obviously has a big play on our desk today. I feel like it's an interesting way to discuss the same story here. As Elon Musk talked about robo-taxi being tested in San Francisco, shares are down 8 of the last 9 sessions. Yes, up a lot in 3 months, and earnings are going to be 1 week from today. So what's your take on the fallout here? Because there was worry after Tesla had its big event a week ago out in Hollywood, and then Uber had a big rally after that, which was deemed a disappointment.
Right.
What do we do now?
Okay. In April, when Elon Musk first tweeted about the autonomous taxi event, it was supposed to be on August 8th, and look at what the Uber stock did in April. It sold it into the 50s. I said it was stupid at the time. I said it was stupid after, and I think it's stupid now. I think autonomous taxis are the future. I think this is incredible for all companies that play in that space. And if you are the central demand aggregator for all of these different autonomous companies that are launching these vehicles out into the street, you are going to make money. And ironically, if Elon is right about where public transportation, private transportation is going, Uber will have a much better take rate than they do today, having to pay as much as they have to pay to the human drivers. So it's going to be probably a 15-year transition between now and when every car on the street is autonomous. I don't think this is like a near-term catalyst for revenue for any of these companies, Waymo included, but I believe that Uber is perfectly situated to be in this position where all of the autonomous fleets that exist, from Cruise, from Alphabet, from Tesla, they will be the demand aggregator, and I think they will be the platform that wins it all.
Okay. Jenny, you own the stock too.
Yeah, I literally agree completely with Josh. I have nothing to add. When has that ever happened?
Wow.
Rest our case, Joanna.
Maybe we can have lots of
We're
time for
done.
final trades
Cut
at the
everybody's
end.
mics. Let's take our
We're
victory.
what, 2 weeks from a record high that we had in Uber. So we got one of the Mag 7s down. We got a lot to go. And it's all going to get real, I guess, next week when Alphabet first reports, and then it's Microsoft, Meta, Apple, Amazon, and then you got to wait a little bit for NVIDIA. You got to wait till late November around Thanksgiving, just before that, before you get NVIDIA. Meta's target today raised to 675 from 600. Reiterated outperform at Bernstein, and I feel like this needs to be debated, okay? They suggest that Meta has replaced Google as the set it and forget it blue chip holding. That's a line right there.
I think they're right, but that says nothing about whether or not that's a great bet today. I think they're accurately describing what's gone on in 2024. Meta is absolutely on fire, launching hardware, getting into verticals where historically they've had to pay Apple just to be in the game. Now they've got the glasses. They're going to launch Orion, which will be a big deal. And they have their own LLM, which is getting all kinds of usage and helping to drive revenue on the advertising side. So there's no question that Meta is and has been the set it and forget it. But the question is, are you rewarded as a shareholder for buying what everyone else considers to be set it and forget it and ignoring the company that's maybe being underpriced? So Alphabet's a 21 multiple. And I think at this point, they're getting almost no credit for what they've been doing with Gemini, which is, go do a Google search right now, bet your bottom dollar, the top result will be an AI-generated response, and they're starting to put ad units in there, just like they have for regular search. Once they've been able to demonstrate that that is a super profitable form of online search advertising, I think the narrative will shift, and Google will be acknowledged as still a set it and forget it ad situation. Right now, they don't get that benefit of the doubt. Zuckerberg does. Congratulations.
Jenny, you own Meta, so what's your take?
So we're starting to get a little worried about Meta up here, because if you think back to, what was it, 3 years ago? It was trading under $80 a share. And that's when this whole like year of efficiency set in. And they decided, oh, we're going to start to really focus on making money. And that's what really underpins the move from 80 to the level that it's at now. And that's what underpins these huge upgrades in terms of price targets. So we need to watch and see if with the shares at 600-ish, like, are they as fiscally responsible? Are they as disciplined? Are they as efficient? And so we have trimmed a little bit. The numbers aren't as compelling, right? The multiple and the earnings growth aren't as compelling as they were a year ago and 2 years ago. With respect to Google, I'm not sure. I still think there's a lot of competition there. But if we look across the Mag 7, that's of them all the one that's most likely to next enter our disciplined growth strategy, in addition to Meta. You know, we've only held
Is that
one
because of the valuation?
Yeah.
Okay.
It's compelling. But I think there's like a lot of competition there, but I don't know really where it falls out, and we're not willing to buy it quite yet.
One general statement on the Mag 7 is anytime you've been able to buy these companies at 20 times forward or less, every single one of them, it's been an incredible opportunity. There are periods of time over the last 10 years where we cast doubt on, can Amazon get it right? Can Apple fix its product situation? Is Microsoft's growth stalling? Every time one of these stocks gets called into question, that historically has represented an amazing time to buy, because eventually these companies have the resources and they do figure it out.
Eventually, but there is incredible disruption and distortion right now. For example, I've really started using Anthropic's Claude, right? More than Google sometimes. Google just gives me random stuff, and I'll ask Claude a really specific question, or what's a better word for, or can you remind me of the history of this? And it's simply a better search engine. So Google's never had that kind of competition.
Speaking of, since you mentioned Anthropic, let's talk about Amazon investor, obviously there. AWS growth and opportunity to support the stock. That is according to Bank of America today. Josh, $210 is the price target. What do you think?
Yeah, look, I think the issues with Google and questions about profitability and growth have been lingering all year, which is why the stock has kind of been in stasis. One of the things that Google has been really successful at on the retail side has been pushing their Essentials brand. Unfortunately, that's come with some margin compression. It's not like the highest margin thing that they do. But that's just one small example of things that the sell side has been harping on this year. I think ultimately Amazon is a must-own stock for investors, and I think this is one of the companies that still has a lot of levers to pull and a lot of hats they can pull out, rabbits they can pull out of their hat. So I don't know that the near term looks much better than what's gone on recently. I just think Amazon at today's levels is very compelling, especially when you consider the valuation multiple it used to sell at back in 2018, 2019.
Let's talk about ServiceNow, the chart of the day. Doesn't get a lot of, maybe enough, frankly, talk on this desk. Ownership isn't vast, but we do have some strong beat and raise. They talked about their AI offering. The stock's one of the best in the market today, up 6%. It's a record intraday high. You had more price target hikes than I can name. Many of them at least 950, some 1,000, if not more than that. 950, it's above now anyway, so that's somewhat irrelevant there. But Jason Snipe does own it, and he joins us now to talk about this stock, which probably should get more play. Tell us why it should.
Yeah, Scott, another great quarter here. I mean, the stock's up around 36% year to date, but if I'm looking at the double beats, it's 8 double beats in a row, quarters in a row. Revenue growth of 22%, EPS growth of 26%. And, you know, one of the things that we think about when we talk about software has obviously underperformed this year. The IGV is only up 12%, and ServiceNow is the 4th largest component of the IGV, and you see what it's doing from a price action perspective. So I continue to like this stock. You know, the renewal rate on the subscription business is 98%. You know, when we think about predictability of revenue going forward, these are companies that you want to be invested in. So we continue to like this one. I know Bill came on the network earlier today to just tout what they're doing over there. So again, love the price action here. I think it's a mainstay for us in the software side.
Yeah, done quite well. Thank you for calling in. Appreciate your time very much, because if we look at software names elsewhere today, they're getting a nice little bump. We could show Salesforce, Oracle, some of the cyber names too are higher today. Josh, you want to talk about some of the cyber stocks that are perhaps up on this? Just the software space in general is getting a bump.
Look, I think for anyone that owns a business, anyone that's a board member at a publicly traded company, anyone that's a private equity LP invested in a fund that's got companies in it, there are no discussions taking place anywhere that have anything to do with lowering the investment spend on cybersecurity going into 2025. Zero. There may be conversations about other SaaS software and where can we trim costs and where can we look for other options and where can we possibly pare back on budget line items. That conversation is not happening in cyber, nor will it. I think this is a secular bull market that takes us through the rest of the decade. And so if you own one of the top 2 or 3 names in this space, you might have a disappointing quarter here or there. But man, do you have a tailwind that, like, I can't imagine something that would derail it. On what planet in the age of AI would we think that the threats are going to lessen? So, and by the way, this is not a risk like, oh, we might not be as profitable. This is an out of business risk. This is a knockout punch if you don't have a premier vendor in cyber and you're not committed to continuing to spend. So congrats to the bulls who have identified the secular bull market over the last few years. I'm going to stay with it. I think it continues to work.
All right, coming up next, we'll take a quick break. When we come back, we got a big committee move to tell you about. Jenny just slashing a position of hers in a tech name. It's been on a tear. We're going to reveal that name coming up. We're back in just 2 minutes. All right, welcome back. Some committee stocks on the move today. Let's talk IBM because it's falling on mixed results, and this is the stock that Jenny has trimmed by 1/3.
Yep.
Now, you did that before the earnings report.
Right.
Okay, which is just take me through the thought process, the timing, and what you're thinking about with this decline here.
So it's pretty easy, and it's interesting. From a fundamental perspective, we were really comfortable selling this stock at $221. From a fundamental perspective, that to me seemed like a really rich valuation, and everything was priced in. It was trading at $221. It was about 20 plus times earnings, versus a historical average of about 16 or 17 times. And we knew that business was going well, but it still only has like high single-digit earnings growth ahead. And you can say, sure, there's Red Hat, and that's the cloud, and they have AI, but the reality is it's still a single-digit earnings grower. So a multiple of over 21 times seemed rich. So at 221, I was willing to get out. But sometimes, this is going to make Josh really happy, I like to take a technical look at things too. And from a technical perspective, right, there's a lot of momentum. And I've gotten really badly burned this year on selling things purely based on my fundamental analysis of when it's time to get out. Like I sold Seagate too early, I sold Iron Mountain too early, because this is a really momentum-driven market that we're in too. So I had asked for a little help, and it looked like it could easily go to 250 on a technical basis. So I had this conflict of, do I sell it at 221 or 250? So going into earnings, I thought, there is so much positive expectation in these shares that it's going to be hard to beat. And I took 1/3 of the position off. I added it a couple years ago at about 140 initially. I increased it when it traded down from there. I've collected a really nice dividend stream. So I've got this like really great, almost 100% total return on it. Why not lock some of that in? And why not put some cash on the sidelines? Because I wasn't sure how today's call was going to be received. And by the way, the numbers are fine. They beat on earnings by 7 cents. They came in with $2.30. They beat, the revenue missed by 100 million on 15 billion, but that's not much. And like the quarter was kind of fine. It was just that there was a mismatch of expectations.
Stock's been up a lot.
Oh, it's up 40,
year to date.
Yeah, it was up 42% year to date yesterday before this.
That's right.
So it's rich.
What is this rally based on since May? They're getting like the AI halo effect?
I think so. I think so.
I don't know that anything really has fundamentally changed with this company.
No, I think it has. Like their earnings growth rate has increased. So if it used to be 5-6%, now it's like 8, 9, 10%. So that's increased. But I saw something randomly a few weeks ago that showed the number of AI patents that all the big tech firms have, and IBM has like the most AI tech patents out there. But I don't think they're for the hottest parts of AI. It's because it's a huge data, big data company.
They have the patent on winning on Jeopardy. I don't know if that's what people are really excited about these days.
I don't know, but I think it is part halo effect, part increased earnings.
You're sort of all over the earnings movers today.
Oh my gosh.
Whirlpool is yours.
Right.
It's the best day since June of 26. EPS beat, revs missed.
Right.
There's a stock that's up near 14%. What's your take on that one?
Okay, so this is the polar opposite of IBM, where IBM puts out perfectly good numbers, right, but expectations were too high. This one puts out like perfectly fine numbers, but expectations were so poor that it actually has picked up steam. I think it's interesting too because my investment thesis on this has a lot to do with when housing turnover returns. So going to Josh's comments on once mortgage rates start to come down, and I think Liz, you said we're at 15-year lows in existing home sales. So once we get away from those, what happens? You buy a new house, you put new appliances in. This has been a lot slower to occur than when I originally bought the stock. You may remember I originally bought it at about 100, I think it was about 128, and then added to the position around 104. But the investment thesis has been the same. Once housing picks up, they start
You want to
benefit.
buy these at 14-year lows in existing home sales because it can't get worse.
Right.
And look at look at Sherwin-Williams. Look at the anticipation.
Right.
For now, you have people painting the homes they're already in. But again, if you get a housing cycle, that's another leg to the earnings story. Whirlpool will play with all of those other names that are in that trade.
Well, and to be fair, I mean, this is better for new home sales, which are doing well, because you can get a deal on rates in new homes, right? You can get a deal from builders on that. So some of these companies are going to benefit more from new homes. But also there's this demographic shift. There are a ton of millennials, a ton of Gen Zers that are going to start buying houses, no matter what the economy looks like. And that is a tailwind, but you have to wait for it.
Right.
I want to mention Unilever out of this Staples group today. Because the stock is in a down tape, one of the better performers. Stock was up 2.5%, just about that. You can see the move here off the earnings. Sales growth beat by 4. It was up 4.5%. First time that all 5 segments posted positive volume. Some talking about the possibility of a re-rating for the stock based on what lies ahead in that company's turnaround. You have this in your international fund. I mean, we can use that as a vehicle to talk about whether we think staples are attractive or too expensive. How do you view it?
I think generally staples are pretty attractive right now, and on our watch list we have several, because you may remember a year and change ago when Walmart said our calorie sales were lower. All the consumer staples that produce food got sloshed. So now they're pretty cheap. But Scott, you'll love this part. You know what was one of the big drivers of earnings? Ice cream. Ice cream sales were up 9.8%. So like, hooray for ice cream on that. And then another driver of it too was that the British pound was stronger. So they had like kind of unique things.
Is that Ben and Jerry's Unilever? Is that their brand?
Yes.
Okay.
Am I saying
Does that
the wrong thing?
compete with your brother at Van Leeuwen?
I don't know. I think it's a little bit different. Like one's a little bit more mass and one's a little bit more boutique still. But my brother would say they did compete.
Yes.
It's good that you mentioned ice cream. I'm glad full disclosure. Right, you can't just talk about ice cream
Van Leeuwen
with the
ice cream,
disclosure.
right.
It's family ice cream.
Right. My little brother's own Van Leeuwen ice
The
cream.
best ice
so
cream.
good.
Delicious.
All right.
It's so fun.
UPS. Earnings beat, you own that one. Northrop Grumman, you own that one.
Right.
Carrier
So
Global, Teradyne, is there one of those 4 that sticks out? UPS, Northrop, Carrier, Teradyne?
Yeah, UPS is really, really interesting because basically it was the first good quarter in a really long time. It was the first positive quarter after, I think it's more like 12 or something negative quarters, and getting to the point before of like, I want to buy low, right? I want to buy this thing when it's got a 4.5-5% dividend yield, when it's down and out. Barclays issued a nasty little report earlier in the week with a $120 price target, and I read through that, and their bear case is like the same bear case that's been floating around out there for a while.
What's wrong with this? This is in a downtrend for 3.5 years.
Things are just moving. There's a lot of competition, but don't forget there were the labor strikes, right? It's distorted. And you know what, Josh, too? It's in a downtrend for 3 years because everything went bananas during the pandemic, and it was a huge pandemic.
Is that 5% dividend good? Is that like cash good?
Rock solid.
Rock solid?
Yeah. And but if you look at the chart, had it not had that pandemic honeymoon halo, whatever you want to call it, it would have been a completely normal earnings trajectory, a completely normal stock trajectory, but it got blown up, so then it traded off too much. They inflected back to growth for the first time in a long time. They've executed really well. They're reaffirming guidance. They beat a little bit. Like, that's a big deal when UPS comes out, and they're over the labor strikes. They're over the labor negotiations. Carriers and Northrop's kind of obvious, right? Like, of course they're going to be. Everybody's rebuilding their military supplies right now. Stock's up a little bit, but I think that was kind of expected. Carrier's kind of interesting. You may remember that we trimmed it, and there have been a couple of downgrades on it lately. And when we bought Carrier, it was trading at something like, I don't know, 15, 16 times earnings. Now it's in the high 20s of earnings. And so it's still an amazing company with huge growth ahead of it as the world continues, like globally, right? As people use more air conditioning, kind of step up their quality of life. But in the near term, the shares are slightly overvalued, so we trimmed it.
Okay. All right. Thank you, Seema. Up next, Santoli standing by for his midday word. Senior markets commentator Mike Santoli joins us now for his midday word. It's kind of a NASDAQ show today for obviously Tesla reasons, but what else are you looking at?
Yeah, of course. Tesla, T-Mobile, ServiceNow, good earnings responses.
Yeah, ServiceNow. Good
that
point.
open was sold pretty much across the board. I think people thought it could actually be, we could draft behind those winners, and it didn't really work. You have more stocks down than up. I think it's a stable day, but it's one where we're not taking advantage, for example, of the little bit leaking lower of Treasury yields, mostly because I feel like we've come a long way. It's a digestion week. I think there was some sensitivity to have we over extrapolated some of the election implications, and now it's a stop and reset. Underlying it all, I mean, the earnings, I think, are going to aggregate to a pretty good outcome. It looks like, it's going to reinforce the case for what we think is going on, which is soft landing and earnings broadening. But, it's a matter of where we've already gotten to coming into this week.
Kind of like a slog this week a bit until you get to the mega cap earnings next week, and then you get the election and, post-election day and see what sort of drama there is post that.
Exactly. And I think, we were looking to the bond market to say, what is it actually telling us? Is it just really telling us that growth has been better than expected and, earnings, inflation expectations have stopped going down and we're in a better spot? Or, is it something more that we have to worry about? We don't have to worry about it, but I do think right now we are waiting for some kind of the critical pieces of data to come through to make that evaluation. I think that today's claims numbers, fine. All this stuff is sort of checking off the boxes.
The data was
without
economic
giving
data pretty
people an incremental reason to get aggressive, because I think equity exposures are pretty full, and we didn't have the typical give back seasonally that you get going into this period, and now we have a coin toss election and people maybe want to sit back for a while.
All right, I'll see you in a couple hours on Closing Bell. It's Mike Santoli, of course, be with us for his final trade later. Up next, Josh has a new trade idea. He's flagging a stock he says is breaking out. He'll tell you which one next. All right, welcome back. Let's take a look at shares of Zoom, which we are right now. Thank you very much. We are, because Josh has his eye on this stock today. Shares are up 25% in the last 3 months, and you previously owned this, but you think we might be having a little breakout again?
Yeah, I did not do well with the stock the last time I was in it, but this is setting up for what looks like a pretty obvious breakout. A lot of technicians are flagging this name, and as I've talked about, we keep a list of the best stocks in the market internally, and this one's checking a lot of boxes. So what I want to point your attention to is the 1-year chart, and what you can see here is we are on the verge of taking out that late August high that actually coincided with a better than expected earnings report. And we might take out the December 23 highs of 74. We're like, look how close. We're like one Pompliano away from breaking out above that level. So what I want you to do is keep an eye on this thing as it breaks. If this is the type of trade that you like to do, I would trail this with that rising 50-day, and I would do a look back every Friday on a weekly basis. A 50-day moving average crossover above the 200, that's the signal, and now she's gone.
What would make you get back into the stock? Noticing and watching the breakouts one thing, buying it's another.
I think it's bad luck for me right now to chase this thing. So I'm flagging it as a technical setup. From an investing perspective, I'm not excited about the name, and most of what I'm doing is investing. But I think this is a really interesting technical opportunity. And by the way, from an investing perspective, it's a cheap enough stock. From my perspective, I want to hear what they have to say on November 18th when they report earnings before I come back into the name. But if you're a trader, have at it, sitting right there teed up.
Okay, it looks like it's on the tee right now, as a matter of fact. All right, thank you for that. NASDAQ, you want to talk about too, on the back of earnings?
This one I am in.
Day.
Yeah, this one I am in. This hit my list earlier this year, and the stock continues to make new highs. It's actually above the old 2021 highs. It's a grinder. Doesn't have like these up 5% days. Nobody really pays attention to it, but very quietly, NASDAQ continues to put in good quarter after good quarter, and that's what we heard today. Most interestingly, the upside in earnings was coming from indexing business and their financial technology business. They're not really getting any growth from the listing side, which is the IPO market. When that part comes back, you're not going to be able to buy the stock in the 70s. You're going to have to chase it higher, because that's really the biggest driver. When you look at the best years this stock has had, it typically coincides with a great underwriting calendar and a lot of deal making. And I think we're right on the precipice of being back in that environment, but we're not quite there yet.
Liz, financials, speaking of best sector this month, Roth Capital today says stay overweight. You could see a pause, but stay around. What do you think?
Yeah, I mean, look, they kick off earnings season. They did well in earnings season this time. They're the third best sector in the index so far this year, so they've obviously seen a nice run. I like the underdog industry groups, though, and that NASDAQ falls into financial services. What we've talked so much about this year is banks. We've talked about insurance because they've led. So now it's time to look at some of the other industry groups that haven't been as hot, and I think financial services is one of them, especially if Index activity continues to pick up. Trading activity continues to stay hot. Options activity is hot right now. There's just a lot going on in that space.
Yeah, I mean, and there is a lot of optimism, by the way, on capital markets and deal making. I've heard it from so many
Globally.
topics. Yes, I've heard it from very, I don't know, 3, 4, 5 top executives in the last week or so, either on TV or offline, that they are very bullish about the deal making environment. Moving into 2025, to your point. Calls of the day next. Stock touching fresh 52-week highs. JP Morgan says it can go another 20% from here. Josh owns it. We'll tell you what it is. All right, we're back. Live Nation starts our calls of the day today. Price target to 137 at JPM. 52-week high yesterday. Josh Brown owns it. What's your take?
Well, my take is I sold half my position in June, so today I feel like a schmuck on wheels. The stock has done nothing but go up since then. And I think the analyst at JP Morgan is going to be right. Here's what's changed about the story and why the stock is moving higher, despite the fact that they're tussling with the Justice Department yet again. They're talking about their cash flow per fan at the venues that they themselves own and operate or just operate being significantly higher than just where there's ticket sales. And this is going to be the future of the business. They call it Venue Nation, and JP Morgan estimates it's a $350 million opportunity. They are going to be building their own situation in a lot of different places and throwing events, and they make a lot more money when they do that than when they just partner with a venue. And a really great example of the power of this is right near where I live, 5 minutes from my house, Jones Beach Amphitheater, which they just did a complete renovation of, top to bottom. It's incredible, and I could tell they're making a lot more money because I know I'm spending more when I go there. So this is a really great growth story. Not a lot of people know what's happening here, and no one is stopping attending concerts. That we thought that maybe would run its course in 2023. It just isn't. So I really like the stock, and I'm sticking with what I have left.
Verizon was cut to sector weight, Jenny, at KeyBank today.
This is like the opposite of a really great growth story. So they announced earnings last week, and they were kind of fine, right? They guided toward the upper end of the range, but behind that there was a lot of messiness. And so KeyBank's not wrong. And in their downgrade, what they say is there's not enough upside. And I would add for them, there continues to be enough upside for me. This is in our dividend strategy. And I look at it as kind of a bond equivalent. So even after their kind of messy backstory to their earnings, even after their guide, even after this downgrade, here's the bottom line. It's trading at 9 times earnings as a 6% dividend yield. Earnings are going to grow in the 3 to 4% range for the next several years. So I look at that and I'm like, all right, I'm putting 6% dividend yield in my pocket. If the share price grows in line with earnings, forget about multiple expansion, you get another 3 to 4%. That's a 9 to 10% annualized return. For a dividend income strategy, that's awfully nice.
I gotta throw a flag. The stock's trading at the same price it was trading in 1998.
Okay, I hate this argument.
Okay, fine, but it's a legitimate argument. And I looked at what the CEO has been paying himself. It's like, where are the activists? This stock literally is like watching paint dry.
That's true.
For literally decades, and I don't understand what's wrong with it.
I didn't own it back in 1980.
I feel you.
That there's always a starting point, and this is where you and I conflict a lot. Where you're like, hey, but if you look at 10 years, or actually where I really
wait. So what's going to change though, relative to the last 25 years? That's my question. 25
years, there's so much disruption in that space, and now it's down to 3 players. It's like AT&T, Verizon, T-Mobile. They're all kind of doing their thing. T-Mobile, it doesn't pay out the huge dividends, so they have better earnings growth than the other two. But you get like really kind of stable, solid, predictable earnings growth. But I got into it with Weiss the other day when he said the same thing. He's like, okay, but if you look back 20 years, and I'm like, okay, but what's your holding period?
Well, here's the point though. There's a reason.
3 years.
Okay, this versus T-Mobile, it's no contest. T-Mobile was the better bet.
Correct, but I want a dividend income strategy.
What's going to change here to make the dividend not be 6% but 3% because the share price doubles?
I don't need that.
Okay.
And they grow the dividend in line.
So buy a bond.
So I can hold. Why would I buy a bond? There's no upside.
Okay. 6% in a stock price that can't go up.
Let's dig down on that. If I buy a Verizon bond, I'm probably getting a 5% yield, right?
Don't buy a Verizon bond.
Okay, but fine. Buy any old corporate bond and go out 5 to 8 years. You're probably getting for decent corporate credit. You're probably getting 5.5%, and you're paying ordinary income tax. So you're paying, call it 38%. Here you get 6% in your pocket. Oh, by the way, and that 5% yield that you've locked in on the bond never grows. That's all you get. So if there's inflation, you get nothing more. On this,
also can't drop 20%.
It
Don't
doesn't
leave that
matter.
part
If
out.
you have a long time frame, you just wait it out. This, you get a dividend at 6% that grows, that keeps up with inflation, plus a little bit of growth on top of that, plus a better tax rate. Like, of course I want this. And all you need to do is like shut your eyes, grit your teeth, and bear it in terrible times. But by the way, go back to 2020 when everything else was terrible. Verizon and AT&T held up pretty well.
All right, we'll take a quick break. We're back with finals now. Finals.
Pfizer.
XAR.
Live Nation.
Thank you.